Hey, what's up guys? So in this video, I am gonna go over I'm gonna go over one of our deals is what I'm gonna do and show you kind of how I think through the process. I'm gonna show you appreciation, depreciation, taxes, mortgage. I'm just gonna walk you through everything so that you can see how they work. Now, this is gonna be one of the smaller deals we did, which helps because a lot of you guys can do this. It just takes a little bit of effort. There are some pitfalls that you have to watch out for, which I'll talk about. But I'm gonna break it down. So we went in and we bought a piece of property at $682,000, okay? Remember, C-class. What C-class means is a C-class property is, I wouldn't live in it. But a lot of people do live in them, but I wouldn't. It's just, they're kind of run down, they're older, but their cash flow is amazing. So we went in at C-class and this is 16 units. You can't be buying 16 units of A-class properties at $682,000. A lot of units, each unit costs that. Okay, so we're into each unit, figured out $40-something thousand per unit is what we're getting. Now, when we bought this property, average rent was probably about $725. There was some mismanagement going on with this property, but for the most part, it wasn't bad. It was almost full. So if you look at the numbers when we got this, 725 times 16, we should be able to get $11,600 a month. Now, that looks pretty good, but in this case, we brought in cash and borrowed the rest. So what that means is it's not like we were clearing $11,000 a month. We brought in cash, so with that $160,000, we were originally clearing about 20% cash on cash. So $32,000 is what our return was, and I like that because if you're clearing 20%, it's only going to take me 5 years to get my money back. That's what I want. I want my money back as fast as possible, so it would take 5 years to get my money back. When we originally did the deal, this is what we were thinking. Great deal, numbers work out. Now with this, remember, we're borrowing the rest. So we're borrowing about $500,000 borrowed, okay? So with the cost of this property, so even though $11,000 is coming in, we have a mortgage, we have taxes, we have insurance, we have property management, okay? And the nice thing with us is on Property Manager, we manage a lot of these, so we make sure that the deals work out better. That's kind of one of our strategic advantage is when we were going into these properties, we noticed they were so badly mismanaged. And a lot of properties are like that because a management company really doesn't care for the most part. If they have a lot of properties, it's hard to juggle. So there's a lot of properties out there that are mismanaged. Now, let me talk about all the benefits of this deal and where it went. We went in, we increased the rents to $775, okay? We did a few other things to get it going, but $775 times, times 16. Gave us $12,000, so we increased it. And we decreased some of the expenses. At the end of the day, we started to get what's called 40% cash on cash return. Okay, cash on cash return, remember, how much cash did I put in it? So 160 is 40% of 160,000. $64,000. So this property right now is paying us $64,000. Well, we went into it thinking we were going to make $32,000. We're now making $64,000 because of some of the adjustments we've made, and that gives us a 40% return on our money. So each month, this is paying us $5,333 in cash flow. Now that looks good. This is good. There are not a lot of deals out there. Some of you guys are going in the whole $682,000 to buy some single family residence, and you're clearing maybe $1,500 or $1,000 a month, if that. And you have a lot of risks associated with that. So this is one of those deals where there's not a lot of them. They can be found. We bought this during COVID when things it was shaky ground. So it was great timing. And remember, you make money in the buy, a lot of times in the sell. Now, not in the sell. Now, what is this property worth? So let me walk you through the additional numbers that we have. So now on top of this, I just got done doing my taxes, and this property, we had a $99,000 basically depreciation. So how much taxes did that save me? I'm in the highest tax bracket, so that saved me whatever, 30,000, 30 to 40,000 K on taxes. Okay, so we bring in this money, but I save this much money on taxes. I get to do this again and again and again. Now, what happened to the price of the property? Right now, if I turn around and I say I want to sell this piece of property, right now, at our current numbers that we have increased the value by double, 2x. So I've had it over a year. We have now increased the value of this to about 1.2. Now, let me explain why. Cap rate, if you have cap rate, this is what everyone talks about. Cap rate on this piece of property, you're gonna take hoping you can see this, you're gonna take the net income divided by the present value. Okay, so if we do that, net income divided by the present value gives us, like, when we went into this, we're just gonna estimate a 10% cap rate is what we were getting. But our net income, I could turn around and go to somebody and be like, hey, you're gonna get 40% even if I half it. If I half that and go to somebody and say, hey, you're gonna get 20% cash on cash return, do you think people will bite on this deal? Yes. If I go to people right now and say, you're gonna get an easy 5% cap rate, you can. So if you do the math, at a 5% cap rate, 64,000, this is where math actually comes into handy. 64,000, you do the math, you're about 1.8 million is the value. So how does the numbers work out? Let me show you. This is where I talk about net worth. You have to make sure when you're doing deals, whether it's buying businesses, whether you're buying real estate, whether you're buying toys, you name it, you need to increase your net worth. Okay? So I have a property that we took at 182,000, now is worth 1.28 million. Okay? I have cash flow that's spitting off, and it's not just me, it's me and partner on this one, $5,333 per month. Okay? So I got 5,000, somebody else is paying down my mortgage. So I have appreciation. This is called appreciation, where your property value goes from 682 to here. This was fast. It was just good timing, and sometimes it's better to be lucky than good. So this was appreciation. So you got a huge jump in appreciation over the last 16 months. Now I'm getting cash flow of $5,332 on this property coming in no matter what. They are paying down my mortgage. So remember, I have a $500,000 mortgage that is being paid down. That it doesn't come out of this. This is cash flow. It's coming out of my overall return that they're paying down my mortgage. Every single month, that mortgage is getting paid down by somebody else that's not me. So I got appreciation increasing. I got my debt decreasing. I got tax advantage of $99,000. This is big. This saved me alone $30K plus, probably more, $30K. So I got $5,000 coming in a month. save 30K, and this is both, but I saved a big chunk on taxes for that. And what else are we missing? And that's it. So that's all the advantages that you get. So you get appreciation, you get depreciation, you get cash flow. You avoid the tax man. That's the biggest benefit. Okay? This is the advantage of doing this. Now, there's one other thing that I was just thinking about on this. Oh, yeah. Okay. So this is the coolest part about doing this. A lot of wealthy individuals don't, like, everyone's always complaining about you need to tax the rich, you need to tax the rich. I don't care. Because what happens is the rich are going to figure out ways around it. They're the ones that create the tax code, so they'll figure out a way around it. This is the best part about this property. Now, let's say we don't sell it. We have a $500,000 loan right now on this property. What's the value of the property? You can go to any bank and you can make your case that, hey, this property, because of the cash flow, because of how much it's paying in rent, is worth 1.2. I can turn around and I can borrow against that. So I can go 1.28 times 0.2, 256. So what I'm doing is I'm showing you a game that you can play to actually not have to pay taxes. And this is what a lot of wealthy people do, is they have plenty of money, or because they borrow against their assets. So you notice my appreciation. I had appreciation of almost $600,000 is what we had. So because of that appreciation, I can then go borrow 80%. Okay? I can go out there and borrow $480,000. So now what happens? My $160,000 that was put into this deal, or my mass that was put into this deal, is now back in my pocket. I now walk away with $320,000 cash. Now the cool thing is, who's paying down my mortgage? I borrow this money from the bank. Now I have $320,000 cash in my pocket. And guess what? Tax-free. If you were to go out and make $320,000, the tax man is going to take basically 50% of that. So $320,000 puts you in an upper tax bracket. They're going to take almost 40. If Joe Biden gets his way, he would take it all if he could. So $120,000. If you were a doctor, or if you were a dentist, and you made $128,000 of that is going to taxes. Well, in this situation, you are borrowing the money, and so you get $320,000 tax-free. And then you could turn around and go play the game again. You could buy more property. It's up to you. But remember, they keep borrowing against their assets because they have tons of assets. And so if they ever need cash, they can just go borrow against it. And then who's paying it down? The mortgage people are paying down the mortgage. So in 10 years, they do the exact same thing. Appreciation. That property could be worth $5 million. Rents have gone up. Now they go and borrow $1 million against the piece of property. They have $1 million cash, tax-free. So hope that helps. This is how the game works. Good luck.